Hi everyone. So in the first session we have completed certain basic level of discussion with regard to the shares and their pricing and other details. In the first session I didn't go much into the details with regard to any share interpretations etc. Just I said what are the types of cash flows that will be possible and how it will be calculated, all these things, the basic analysis we have done. Now what we are going to do more about understanding the dividends, its impact and the scope in which the share price movements will be happening. Mainly in this particular lectures we are going to have three different parts, mainly three different lectures you can expect. Each lecture will be around 1 hour 30 minutes to max 2 hours, a 6 hours lecture. These lectures will be covering out the fundamental and technical analysis of a stock. Sir, what do you mean by fundamental and technical analysis of a stock? What are the basic aspects one should look into while purchasing the share from the stock market? Live quotations we will take and try to analyze them. That's one way. Second important thing is technical analysis. Means what? The candlesticks movements, what you are seeing on the screen, the white candlestick, black candlesticks. Today the black candlesticks and white candlesticks concept has gone. Green and red has replaced them. So anyway, concept is same. And dozy candlesticks concept is there. Market live we can take the quotations and try to interpret them. This is totally very interesting aspect in itself, where we are going to analyze the securities patterns. Now question will arise, sir, you are going to explain us the market quotations, live trading, okay, how the candlesticks has to be interpreted every day in the market, the price movements, how dividends impact them. You will explain, sir, very good, we are happy. But will this be applicable for our examinations is a query. Sir, you are explaining these only for knowledge sake, or really these are applicable for our examinations is a question now. That question I will answer in two different parts. Two different important things we need to understand. Number one in that, there are two aspects in stock market analysis. First part is principle based financial management analysis. Principle based financial management analysis means models we will take, various dividend valuation models, share valuation models we will take some numbers from the questions, apply the formula, understanding how the formula has come, derivation of the formula, background of the formula, and applying numbers to that, getting the perfect answers from the exam point of view. This is called as a principle based financial management. Means what? What is the principle that is formulated by one economist? Take Gordon, Modigliani Miller for that case, or Sharpe's single index. Any model you take one model. What he want to convey, the principle he is based on, the principle on which the concept is based, taking and extracting that principle, applying the numbers on that, getting the solution is one way of doing. Here, no analysis on the real live stock markets in that are going on. But there will be another area that's called as a operational area. What area, sir? Operational area. Operational area of a stock market is understanding the price movements every day. Okay. Till now you have seen only company law and other angles of question. Now you will see the stock market analyst inside. Okay. Till now I didn't concentrate on that area. That's all. Various reasons. For various reasons I didn't concentrate in that area. Okay, you will see how stock analyst will be there inside. Okay, how the price based movements will happen, taking a P&L account or a balance sheet in hand, how to analyze a company stocks, ratio analysis, all these things we will understand very clearly in detail. That's what we will call as technical analysis of the stocks. What we call, sir, technical analysis of the stocks. So ratio analysis, the current assets, current liability proportions, all these things we will analyze. Okay, there are two parts. One is a principle based analysis. Second one is the operational aspects of stock market. When operational aspects of stock markets are concerned, we are not just going to theoretically do problems and answer. We will directly understand the live market quotations, understanding the candlesticks, movement of the candles. Okay, there are three kinds of candles that are popularly used. The Dow Jones theory will help us to understand there are three types of candlesticks. Number one is a white candlestick, black candlestick, dozy Japanese candlestick model. These are the three popular candlesticks that always analyze the patterns of the shares. So next issue. Sir, patterns of the share, okay sir. How can we really tell that, sir? Because of these candlesticks, etc., the analysis what we do, really the price movements will happen accordingly? First point. No person in the world can exactly tell that what will be the share price in the next 1 minute. God also can't know that. Understanding God is much easier than understanding the price patterns. Okay, price patterns, candlestick movements will help us to understand the sentiment of the investor. It will not give you any information about how it will be in the future. It will give about the present sentiments of the investor. Based on that, we can assume and tell that like this it can be in the near future in another 2-3 days of the trade market. Okay, so directly on any what to say hard and fast rule, we can't tell that this will be the share price. No one in the world can tell, including Warren Buffett, including Rakesh Jhunjhunwala. No one can tell this will be the share price. But what we can tell, on the basis of the investor sentiments, political analysis, on the basis of monsoons, everything we can analyze one important point, that how share might be affected if these factors are impacting them. Listen carefully. Markets always getting affected not because of the reality. Markets get affected by information. Okay, markets get impacted by the information. What information? This time monsoons will be very bad, say for example, which should never happen. Okay, so monsoons are very bad. Low centimeter rainfall will be recorded. Information came from the weather reporting departments officially. Monsoons will not be so promising this year. We received an information. Immediately stock markets will crash. Monsoons, stock markets, why they will get affected? Monsoons and stock markets are having a huge link, because whenever rainfall impact is there, agriculture based industry will not flourish. Okay, agriculture based industry means it also includes food and food processing industries. Market will not take that information totally taken as a dearer thing. It will be taken as an anti. Markets will immediately crash. Somewhere government has taken some policy decision, means immediately stock market prices will increase and decrease like a monkey on a single trading day. Why? Stock markets are not influenced by the facts. They are influenced by the information available. Okay. Now listen. RBI increased the repo rates. RBI decreased the repo rates. Reverse repo rate has been increased, reverse repo rate has been decreased. PLR rates increase, SLR rates increase, decrease, etc. Impacts the share market. Sir, bank has increased interest rates, means why the stock market is getting affected? Stock market is not a bank. Why it is getting affected? In India, most of the stock market traders are having a financial leverage. What is that, sir? Financial leverage. Financial leverage means what? When I put 100 rupees in the stock market, totally 100 will not be my own money. I will bring some money as a finance from the outside debt, and some amount I will bring in the form of my own funds. Obviously, borrowing is one of the very, very important element in every kind of stock market trading. What is that? Borrowing element. Now, on this borrowing element and its importance only, in portfolio theories, we will look into one of the model called as a capital allocation line, where borrowings will be analyzed there. Okay, when we come there, I will explain in depth. As of now, try to understand. I am a stock market trader. I will purchase and sell the shares. On a fortnight or a monthly basis, I will buy and sell. I bought the stocks of TCS, taken a loan from the bank, 50 lakhs. I purchase the stocks with an intention that it will increase in near future. I purchase with 50 lakh rupee, borrow. 50 lakh my money, 50 lakh their money. I'm a big trader, invested 1 lakh, 1 crore. Immediately I received a information from the RBI that all floating rate interest rates are going to increase. Immediately heart trouble started because of one good reason. I already borrowed floating rate. Immediately the bank changes interest rates means obviously what will happen? My borrowing rate will increase, but the companies will not pay excess return. They will give the same return. Therefore, market will take that information negative way. Information affect the stock market. In reality, when it will become, when the change will come, all these things stock market will not listen. Stock market will listen only to your information. You give some information, I will get impacted. You give some information, I will laugh. You give some information, I will cry. This crying and laughing will happen on the stock markets, not because of the facts, but because of the informations that are available. This is one very important point to understand. So, summary of what I said is, markets will work on information. Okay. But here the point is, how correct this information is, how valid this information is, how accurate this information is, and how many persons are having the access to this information. If the information is not having the access to all the persons, insider trading can happen. Okay, so for that SEBI has come. All these things we know, the corporate law issues, everything we know already. SEBI is an entity which will see whether the information is correctly flowing inside the market or not. Malpractices, everything it will look into. So anyway, let's not go into the law issue. Let's stick on to our stock market analysis. Now the problem is, whenever the stock markets are concerned, they will get impacted by the information. Whenever company releases its quarterly result, profit comes, market will go up. Profit decrease, market will come down. Like that, various things will impact. Now the question is, government said that interest rates are reduced. Government said interest rates are reduced. Market should go up on the day. Even on that day, sometimes market can come down. That means, other than this, certain other things are also impacting them. Okay, that means correctly no one can tell that, okay, today reverse repo rate or repo rates or interest rates have been reduced by 0.3%. So immediately market should increase. It may increase, it may not increase. We can't give a guarantee. There will be increase, but there will be other things which are impacting on a decrease side much more higher than that increase. What factors will influence? No one can understand. That's why stock market is always a $1 million game which we don't know. It's a blind spotted game where we can't exactly tell that because of this it should increase. We can't tell like that. We really can't tell like that. No one can tell in the world. Definitely market will go up by these many points. No one can tell. Okay, because of what reason? Because if only the information in the market is going to affect the stock markets, other than that, no other thing is impacting, that's called as efficient market. That's called as which market, sir? Efficient market. All the investors in the market are having access to the same information. Everyone is having the same knowledge of information. Markets are impacted only by that information and not by any other sentiments and aspects. If that be the case, we call it as a efficient market. We call it as what, sir? Efficient market. If market is efficient, we can tell to large extent accurately what will be the price of the share in the very next day. Exactly we can't tell. Approximately we can tell. But when the market is not impacted totally by the information, also the sentiments are coming inside and influencing the price and tinkers it, we can't exactly tell which sentiments are exactly impacting them. These are called as semi-efficient markets. Least efficiency, weak efficiency market is such a market where information is not at all affecting, sentiments only impacting the stock prices. Say for example, sir, in India, I will tell who I have demat account means some persons will raise the hand. Who purchases the shares of so and so company online, like people will raise the hand. Now if you ask why you invested in that share, he will tell I invested because someone said me. I invested because yesterday I saw the prices have gone up, or my friend has invested, or my brother is working in that company. That means in all these examples, sir, you check yourself why I invested in this share, on the patterns, past history, all these things we will invest. No one will really make risk return analysis. Taking a pen, taking a paper, write down all the returns that were given in the past, analyze the future, forecast the future, and how many are investing in that way? 100 la not even one person is doing in India. What is the pattern of our investment? We invest on the basis of sentiments. Sentiments does not mean God, etc. I'm not talking about that. Sentiments here represents mostly lesser analysis on the stocks, more on the other information basis. We don't see the PE ratio of that company. We don't see the dividends that were paid in the last years. We don't analyze their P&L account balance sheets. We won't analyze anything. Just blindly we will put money and we will ask for profits. This is the way in which markets are running. We call this as a weak efficiency market, because why you are buying and why you are selling means you only don't have a clue. Okay, if I ask, what is the LIBOR rates during the day, what is the MIBOR rates during the day, what is the SLR rate of RBI, what is the PLR lending rate, what is the cash reserve ratio maintained by all the banks, and how the bank market is getting affected, no one has a clue. They will just tell why you invested in HDFC means I invested in HDFC because most of the people are getting profit. This is called as a sentiment impacting the markets rather than your analysis. Therefore, one should know to make a fundamental analysis and a technical analysis of the stocks before they make the investments. What they should know, sir? Fundamental analysis and technical analysis. Fundamental analysis means what is this company? What is the history of the company? Who are the directors of this company? What is their past record? Are they ethical or unethical? What business this company is into? Whether it is a discretionary commodity or an essential commodity. If it is a discretionary commodity, high discretionary or low discretionary. If it is a mandatory commodity or an essential commodity, what essential item it is? Food industry or FMCG sector, which one it is belonging to? What are the debt equity ratios of this company? These are all called as a fundamental analysis of the stocks. Taking out its P&L and balance sheet, understanding their current ratio, liquid ratio, interest coverage ratio, turnover ratios, asset turnover ratios, understanding the impact of debt on that company, analyzing their EBT to EBT, analyzing the sales to EBIT, analyzing the EAT to EBT, financial leverage, operating leverage and combined leverages, understanding the position of the company. Okay, now going into the stock market analysis, taking its 26 weeks past trend, closing prices and opening prices, candlesticks movement up and down, the black candlesticks and dozy candlesticks, understanding all these things is called as a technical analysis. It requires a lot of stock market knowledge. In this chapter, we are going to analyze about all these issues. Everything whatever I discuss, we will deal in a in-depth way. Crash Bachelor, some concepts which are going in depth, I will be deducing them. Regular batch recording na in depth la stock market live trading also we will do. I told you na principle based, operational based. Principle based we will do in crash batches, that means for examination purposes. Operational aspects also I will do for them, but live trading everything we will do in the regular classes. Crash batches, live trading and all that we won't do. There I will show you how the candlestick movements will happen, everything. I told you na, there is another angle in me, that another angle people will see. Okay, till now I have shown only one angle, na? There is a second angle. No concentration in the last 1.5 to 2 years. Na? Now if I concentrate how it will be, let me show. So the point that everyone has to understand is how these candlestick movements and everything will happen, the analysis of the company balance sheets and P&L, all these things we are going to see in this chapter. Now question will arise, sir, you are telling about all these issues, we are happy with that, are these applicable for our exams? Do you know what is the answer? See my answer now. See here. If you observe this, it is very clear. In our chapter called as security analysis, whatever I have discussed now, everything is there. We are not preparing those, since questions are not so frequently asked. That's why in the last attempt 8 marks question came from this area, last attempt. See here, this is called as fundamental analysis of the stock. There if you observe, here they have given the derivation of a formula, d1 by ke minus g, d1 by ke minus g. Okay, d0 into 1 plus g means what? D1. K minus g means what? Ke minus g. Okay, that model is called as Gordon's dividend growth model. How this formula has come, how it is going to impact everything, we are going to analyze in this chapter first. That's why I am not a mad fellow to start first with dividend analysis. Sir, I can also start with the forex, other things inside this. Okay, more and more enthusiasm can be created, but still pattern is always a pattern in learning. Suddenly derivatives means who will understand? Basic chapters. Now first thing, dividends. So how stock market will start? Security analysis, a basic level of understanding, everything we need to know. Okay, so security analysis involves systematic analysis of risk return profiles of security. That's what I told you. It is not just about information that is gathered. Okay, we have to understand risk and return patterns of a security and then invest. That will be called as efficient market. See that security analysis security analysis involves systematic analysis of risk return profiles of various security, which helps a rational investor. Sir, what do you mean by rational? Who works not on the basis of sentiments but on the basis of available reliable information. Okay, to estimate value for a company from all its price sensitive information and data that he makes purchases when the market underprices some of them and thereby easily earn the reasonable rate of return. Meanings you can understand only once we go into the analysis part. Okay, sir, financial management topics and chapters are more abstract in nature. Means we have to create a different world to explain to the student, not just putting some numbers, answers, 8 marks given in May 2022, 6 marks given in November 2021. That itself is not enough. There is a career based on financial management, which we call CFA, which we are doing now. So CFA is such an area where we have a career inside the financial management aspects. So therefore, financial management, when we are learning, learn from exam perspective. No doubt it is important, what I will also do. But operational analysis of the stocks is also equally important. That's why a chapter has been inserted. Two approaches are there: fundamental analysis, technical analysis. Okay, fundamental analysis, technical analysis. Fundamental analysis means dividends and other things we will analyze. That's why I named it as a dividends impacts on the shares. Okay, we will do all those things. Formula derivation, everything we will do. Everything. Economic analysis, monsoon, how it impact, inflation, how it impact, industrial sectors, how they impact, GDP analysis, everything we will do in this area. Okay, industry analysis, how that company's industry will work, everything we need to understand clearly. Now the company analysis, I told you now, net worth, book values, how they are using their funds, how they are utilizing their funds, understanding the history of the company, everything we need to analyze in this area. Okay, once this is completed, we will go into the technical analysis of the stocks. Okay, Dow Jones theory, charting analysis, charting techniques, understanding how it should be, how the closing prices and opening candlesticks will be understood. Okay, candlesticks, market indicators, efficient market hypothesis, taking this information, how to draw a chart, how the companies will analyze the stock prices, all these things. Price patterns, whenever in the market they will show like this. How to understand this? What do you mean by this? Like a snake, why it is moving on? Meanings we will understand. Those are called as head and shoulder top patterns, inverse head and shoulder patterns. We will understand what is head and shoulder, not shampoo. Okay. So we will understand everything. Efficient market hypothesis, evaluation of technical analysis. All these are in a chapter called as the efficient market hypothesis. Okay, efficient market hypothesis. One very important concept to understand. Strong efficiency, reflect all available information, reflect not only information found but also other publicly available information. Price reflect all information found in past records and volumes. Empirical evidences of weak efficiency market. Semi-strong, strong efficiency market. This question was asked in 8 marks in the very recent attempt. Understanding the market price movements. We will do everything. This is the chapter we are going to start with. It's not just about understanding theoretically, it is about understanding in a practical way. In a crash batch, now we are starting first with the fast track batches. In fast track lecture, I will explain everything, sir. No doubt. Conceptually, like regular batch, I will explain. Problems when they do 20 there, I will do only 8 to 10 here. Okay. Concept, everything will be injected with that concept, and these 10 or 15 problems, whatever we do, 350 to 400 problems we will do in that area. Regular batch, 750 to 800 we will do in class, not homework. Okay, in book 800 problems is not my criteria. In class, how many we do directly? Practically when we do, then only clarity will come. Various issues we need to do. Okay, I will take hard concepts for crash session. In regular session, both easy, difficult, moderate, everything I will keep. Okay, so understanding the bullish market and bearish market, how they work, all these things we will see. Okay, so our chapter is security analysis and dividends impact. I name it as dividends impact and security analysis. See there, the learning objectives are understanding the market value and fair value, how dividends impact the value of share using a traditional dividends model, dividend growth model as per Gordon, understanding PE multiple and interpreting in a right sense, understand the concept of sustainable growth rate, fundamental analysis of the stocks, technical analysis like Dow Jones theory, charting techniques, GDP impact, candlesticks and their practical interpretation, black candlestick, white candlestick, dozy candlestick, of efficient market hypothesis and understanding them. These are all the various things we are going to do. After this, optional lectures I will keep. That means live trading, stock market analysis, trading candlesticks I will show you. If you want, you can listen. Fast track, sir, I don't have time, skip that lecture. Okay. So this is what I want to tell at the beginning before we start with the dividends model first. Market value and fair value. Okay. Let's start. So now let us concentrate on understanding the market value and difference between market value and fair value. Okay. Difference between market value and fair value. Let us try to understand the concept of market value, fair value with examples. See, understanding market value and fair value. What is the difference between both of them? Let's understand first. See there, understanding market value and fair value. Value of any asset means what? Value of any asset is present value of future cash flows discounted at required rate of return. Here, when I use the word value of asset, value here represents a fair value. Sir, I didn't understand. I will ask you one question. What is the value of this calculator? Okay, you will tell that, sir, this is 100 rupees or 200 or something. That's a market price. It's not fair value. What is the fair value? How much revenue this calculator is giving to you? Can you quantify that? If you can quantify, tell me how much is this. That's a fair value. Fair value is cash flow analysis. Market price is a general market demand and supply forces impacting it. Okay. So manufacturing cost is different. Fair value is different. Okay. I will give you an example. There is a lot of difference between price and value. Market will have price. Asset in the company will have a value. I will give you an example. Maybe you can understand with this. If I tell you which is more costly, gold and water, What you will tell? Obviously, sir, obviously gold. Okay. Which is more valuable, water or gold? I will not give you gold for 1 year. I will not give you water for 1 year. Which you will be sacrificing with? Obviously gold. You will tell, I can compromise easily 1 year if I don't wear the gold, or if I don't purchase the gold, or if I do not hold the gold. What will happen? Nothing great will be changed. But water, na, 1 day, it's over 2 days is enough, you will die. That means what we have to understand here, water is having less price but more value. Gold is having high price and less value. Financial management considers values, not the prices. Okay, it is not a price analysis, it's value analysis. Therefore, whenever financial management is concerned, it will not tell profit maximization, it will tell wealth maximization. Wealth comes from value, profits come from the selling prices and purchase prices. Okay, selling prices and purchase prices gives the profits, what to say, the real value of the company will create the wealth to that company. Okay, so therefore we call registered valuers, we don't call registered pricers, price analyzers, like that we don't call. Registered valuers, even under section 247 of Companies Act, we call them registered valuers. They will value they will calculate, not the price. Means they can directly tell, okay, hey, this price is 250 in the market. Or if the price is what we want, can't we see in the market directly? We don't want prices, we want value. So will value really change? Yes, value changes on the basis of the utility that it is providing. What is a utility it provides? I will explain you with 2-3 examples, you can understand this better. So listen carefully, everyone in the class. So the main model of valuation is how it is going to be utilized. I will give you an example. Tata Iron and Steel Company Limited is purchasing, okay, a very big iron winding machine. Iron has to come, pass through that liquid iron in a heat process, and it will get winded into that, and iron rods will come out. Tata Iron and Steel will use that. Okay, forging machines are there. So those forging machines are Locarno forging machines, all these things will be there. Na? The machine which will convert the liquid iron and steel into tubes, etc., ingots, all these things will be there. Na? So ingots, bars, everything, they will prepare that. So that will be manufactured out of it, it will be coming out. This is what Iron and Steel Company will do. There is a machine which manufactures garments. If you put the raw cotton into the machine, a cloth will come at the end of the process, which takes around 1 hour to complete the process. Tata Iron and Steel Company Limited purchased a cloth manufacturing machine for its company. Company is in iron and steel, it purchased a cloth manufacturing machine. Okay, it purchased the cloth manufacturing machine. What will be the price of the cloth manufacturing machine? It's 2 crore. What is the value to this company? Zero. Because in my company I don't put it into the utility. If I put that machine into the utility, outcome will come, outcome I will sell, inflows will come, from that inflows I will deduct all the outflows, net inflows will come from that machine, I will estimate those net inflows what I get, I will discount to the present, I will get the fair value of that machine. Tata Iron and Steel Company Limited don't use that cotton manufacturing machine. Therefore, cash flows for all the years will be zero. Zero when discounted will give zero value. Though the price is 2 crore, my value is zero. So what is important for us? Value is important, not the prices. Clear? Therefore, share prices are not important for us. Though generally in a general speaking terminology, people interchangeably use the share price, share value. Market la what is traded is the share prices only, correct? When you see the CNBC profit, etc., prices that are scrolling on the TV, those are all prices only. But what is the value for you is important for us. It's not about the prices that are getting traded on the markets. So, our target in SFM is valuation, 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 and valuation. We are not fixing the prices. We are calculating the value. Value depends on your utility, not on the markets, how they are. Okay, so listen carefully to the point now. value of any asset is present value of its future cash flows discounted at a required rate of return. Here value represents a fair value, not the prices. Let's see the difference now. Particulars, market value, fair value. Source, from where the market value will come, open market it is available. But from where the fair value will come, fair value is not from the market, fair value will be from the estimated cash flows you are going to get from that machine, from that stock, from that asset. Which influences market price? Demand supply factors. Which influences the fair value? Cash flows, life of that particular asset. If it is a share, perpetual, life of that cash, life of that particular machine or building or share, etc. And what is your PV factor required? These three factors impact fair values. Demand supply forces affects the market value. Next one, model. Markets are always non-scientific in nature. Demand supply, why it will increase, why it will go, who will tell? It's a non-scientific based models. But fair valuation is mostly scientific with proofs also. Empirically they will tell. Why you are estimating this much cash flow means they will have the proofs with them in on hand. Okay, next. Valued by whom? Valued by the entire market. Market will decide it. Okay, who will decide? Market will decide. But fair values are not market decided. Those are expert valuers will come. Section 247 of the Companies Act talking about the concept of registered valuers. Okay. Use of market price, a general analysis. Okay, price increase, price decrease, this is how the movement is there. For that it is. But the technical analysis and project approvals, fair values are only required for us. So this is the difference, basic difference that we can understand between the market value and the fair value. Next. Sir, theoretically understood. Sir, can you explain practically the same thing? Yes. I will take one small capital budgeting problem and I will explain you how the market values and fair values has to be understood. See there. Understanding the difference between market value and fair value in a practical way. Let us consider a simple capital budgeting model to understand the difference. See here. There is a machine. There is what's a machine. That machine is available in the market for 5 lakh. Example, or 4 lakh. I will take two situations. Price is market value of the asset. In the market I went. I asked how much is the price. He said, sir, MRP 5 lakh. Or he said MRP 4 lakh. Let's understand this. Let us consider a capital budgeting model in this way. A machine, if you purchase, a company will purchase a machine. Company estimated that net cash flows that it get from this particular machine is 1 lakh in the first year, 3 lakh in the second year, 1,50,000 in the third year. It is expecting these cash flows. Whatever you are seeing on the screen, these are all expected cash flows and current or future cash flows. Okay. You are purchasing the machine today and in future today. These are all today's cash flows or future cash flows are future cash flows. You can't tell the total cash flows from the machine is 3 lakh plus 1 lakh plus 1 lakh 5 lakh 50. You cannot tell because all the three cash flows are belonging to three different time frames. For example, sir, in my pocket I have $100, pound 50, euro 70. How much is there in your pocket? If a person asked, what you will tell? I have $220 pound euro. You will not tell. Or you will tell, I have 220 currencies. You will not tell. Convert all these things into one common currency first. Convert all dollars into rupee. Convert all pounds into rupee. Convert all euros into rupee. Or convert all the currencies into dollar or pound or euro. First take one common currency. Convert everything into that currency and then compare. That will be the correct comparison. Okay. Likewise, 1 lakh is belonging to first year, 3 lakh is for the second year, 1,50,000 is for the third year cash flow. How can you compare all the things and add directly and tell 5,50,000? How can you tell? So we are purchasing the machine today. Therefore, bring all the cash flows to today. Today means not 1. Today means 0 year. Today. Okay. After 1 year, I will get 1 lakh. What is the today's value for that? 90,900. 3 lakh I will get at the end of second year. First to bring to first year, next to bring to 0 year, it became 2,47,800. 1,50,000, 3 years after I will get 322, 221, 120. 3 times we need to discount. 1,50,000 51,650 is the present value. Okay, why present value? You are purchasing the machine present way. Today you are purchasing machine means today you are putting some outflow. So the inflows what you get also you should bring into the same time frame to compare. So we brought it. How much is the discounted cash inflow? 4,51,350. Now you will compare and tell that an NPV positive, NPV negative. But understand clearly, this is a more kiddish way of understanding. What is a more practical and expert way of understanding the same? This 4,51,350, we call it as fair value of the asset. We call it as what's a fair value of the asset. Why? See there, what is the value of the asset? As I already said, present value of future cash flows discounted at a required rate. Okay, see here, these are all present values of future cash flows discounted at a required rate. Therefore we got the fair value. Done. I repeat, present value of future cash flow discounted at a required rate is the fair value of the asset. Therefore don't call it as a disco, like that. Don't put the name. That's a chinna pillal concepts. Pilla batch ki ad ardham avutundi. But we are experts now, na? At least we presume that we are. So therefore it's not disco, it is fair value of the asset. Fair value of the asset is 4,51,350. How to interpret this 4,51,350? This 4,51,350 is the value to this company. The person, the CFO, who is valuing this capital budgeting decision, he is expecting a cash flow of 1 lakh rupee after 1 year, 3 lakh rupee after second year, 1,50,000 at the end of third year. Really those are bond paper written. 1 lakh really the machine manufacturer said that definitely Kaushik Mukesh, you will get 1 lakh at the end of first year, 3 lakh at the end of second year, 1,50,000 at the end of third year. I am giving you stamp paper, indemnity guarantee bond. If risk is there, I will bear, no one will give. These are all guaranteed cash flows, estimated cash flows. These are all estimated because it is a futuristic in nature. This is a futuristic in nature. You are expecting how much return? 10%. Example, I take 10%. It may be 12, 16, 14 like that. 10 I have taken example because it is easy for understanding for everyone in the class. So the fair value of this asset is 4,51,350. 4,51,350 is called as value to me. How much in the market irrelevant for me. The value for me is 451,350 only. Okay, the value for me is 451,350. So I will now compare the fair value with market value. Okay, see here now. Market value of the asset is 5 lakh. Fair value of the asset. $451,350. Now, if you compare both of them and answer, now let us answer this. Tell me, how much is the worth of that machine to me, my company, to the valuer? How much is the worth of this machine? 4,51,350. But how much is the market value of the asset? Okay, 4,51,350. What is the market value of the asset? It is a 5 lakh. That means I have a negative number of rupees 48,650. This we call as a negative NPV. That means what is the logic here? NPV is nothing but difference between market value and fair value, which we try to ignore at CA interlevel. We are very busy in mugging up the concepts and numbers rather than understanding the concept behind. So market value, fair value difference is NPV. Okay, net present value, not net present price. Value calculation is there. We are bringing everything into present. Therefore, net present value. Sir, everywhere. Next one. Market value of asset is how much? 4 lakh. But worth to my company is 451,350. Therefore, here I have a benefit flowing to me 51,650. 350. 51,000 what's a 350. This is called as NPV calculation. NPV is nothing but calculation of difference between fair value and the market value, or market value and the fair value, as you can consider. Okay, so what is a fair value? Fair value is not the value prevailing in the market, it is a value to the person valuing the asset. Okay, by taking into consideration three things: cash flows, required return, and the life. Here life is 3. That's what I have given here. Cash flows, second bit fair value. Cash flows for second column. Holding period 3 years. Required return 10%. Those factors will give fair value, but market value, manufacturing cost, so after the demand and supply factors will influence them. Okay, market value analysis you will not do here, you will do in costing. Okay, market price, whether it is correct market price or not, that we will do in, not here, that we will do in standard costing. Okay, that's a costing department will look into that, but this is a financial management department. They will not look into the cost, they will look into the value. Cost department will look into the cost of the machines. Financial management will discuss about the value of that machine. Value and cost both are two different departments, which we have to understand very clearly, and the difference between both of them. Okay, so costing department and financial management department both are irrelevant, not even matching departments. Okay, so this is the idea behind the first learning objective. Hope everyone is having a clarity. If you have any doubts in this regard, please, anyway I am posting this lecture also on YouTube now. If you have any doubts, please put your messages in the comments below. I will definitely answer to those questions. Okay, but before going into that, please share this lecture if you like, because when analysis is done properly, we also require that amount of canvassing for understanding. It should reach so many people now. Please support us in doing that if you really like the lectures. Next, how dividends impact the value of the share. Using traditional dividends model, I will explain first. Okay, so now first learning objective we completed. Let us now move on into the second learning objective of this particular chapter. How dividends impact the value of a share. Using traditional dividends model, we will understand. In the beginning lecture, if you remember, I said there are 4 types of cash flow: single cash flow, multiple cash flow, annuity cash flow, and perpetual cash flows. There I explained everything except perpetual. Now I am going to explain that. Okay. Okay. So topic 1 completed. That topic number 2. How dividends are going to impact the share prices. Okay, before going into this, write down the notes, sir, everyone. Write down the learning objectives. Write down the learning objectives, everyone. Once you write down the learning objectives, I will be showing also the remaining notes. Once you copy, we go to the next issue. Hope everyone copied up to there. So please copy down this. So notes copying is mandatory in a crash batch as well. Regular crash, I told you, discussion is same. Number of problems we solve and problem discussion will decrease here. So regular batch, crash bachelor, difference will be there on problem discussion, not on concept discussion. No compromise in regard to concept, because anyone who take the classes should get more than 60. For that, concept is important. So just reading and going on the concepts does not help you. So therefore try to understand everyone. Crash batch or fast track batch and regular bachelor, the only difference is problems we do and problematic discussion. 100 problems we will discuss and do there. Here we will do only 40-45 problems. Anyway, student can do the remaining. So that's a motive. So please, notes is very important for our classes. How la we write the notes, in the same way we have to write our notes also for SFM. Please make a conscious effort to write each and every point clearly. completed. Next one. So hope everyone complete up to here. So see here, till now we completed the concept of understanding the market value, understanding the fair value, all these things completed. Now we are going to understand how the dividends are going to impact the value of a share. How the dividends are going to impact the value of the share. Really will the dividend impact? Let's try to understand. See here. Just now we understood that cash flows of an asset will decide the fair value of that asset. Likewise, cash flow of the share will determine the fair value of a share. What is a cash flow that a share will give? The cash flow on a share we call it as dividends. Therefore, necessarily dividend will impact the prices of the share. Dividends will impact what, sir? Prices of the share. Okay, now let us understand how it will impact. See here. Write down the notes along with me. The estimated cash flows of an asset will influence the value of that asset. The estimated cash flows of an asset will necessarily influence the value of that asset. How? Interest for a debenture, rents for a building, it is dividend for a share. Hence, dividends are going to impact the share prices. How? We are going to prove now. See here, see here, present value of perpetual cash flows. Present value of what's a perpetual cash flows. Perpetual cash flows are those cash flows which will come every year till the perpetuity. I don't know where it ends. For that we need to calculate a present value. For that we need to calculate a present value. The formula for present value of perpetual cash flows is all the formula will be in the boxes. CF per annum divided by required rate. Means what? Cash flows per annum divided by required rate. What is a cash flow per annum? Every year end you will receive one cash flow or not, forever that cash flow per annum divided by required rate. Technically I can tell like this. Present value of perpetual dividends means, how can we write this? Present value of perpetual dividends can be written as array. Yes. So present value of perpetual dividends will be dividend per annum divided by what is the required rate on a what is the required rate on a share? We call it as KE. Simply instead of writing like this, people write this as D by KE. D by KE will be present value of perpetual dividend. Okay, present value of perpetual dividend D by KE itself is called as P naught, also called as value of share today. So to understand this, I will explain in a more crystal clear manner. See here, fair value is 4,51,350. What we have done? We have taken the future cash flows, brought into present value. That present value itself we call it as the fair value. Likewise, here also perpetual dividends are taken. D by KE we have taken. Perpetual dividend, every year same dividend will come. We have taken D by KE. That will be called as a present value of perpetual dividend. That itself will be called as a price of a share. I repeat, how 1 lakh, 3 lakh and 1,50,000 brought into the present value became fair value. Constantly one dividend till perpetuity is going on, we brought into the present value, will become the value of a share. This is a traditional dividend model. I am not telling this is a model we are using today. This is a traditional dividend model. That's why I have clearly given here how dividends impact the value of share using traditional dividends model. Later we go to dividend growth model. In this model, growth is not considered. 2 rupee, 2 rupee, 2 rupee, 2 rupee, forever if it pays. How the value will be, we are going to see. But a question will arise. Sir, what is the proof that CF per annum divided by RR will really give you the value of an asset, or dividend per annum divided by KE will give the value? Okay, I will give you an example. This example, CA inter booklet is there. Time value of money concept is there. Na? Perpetual time value of money. This example is given by the CA Institute. I am taking that example to make you understand. Okay, see here. I will give you 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh forever till you live. Okay, or for that ask a bulk amount today itself. What you will take? I asked. I said, you are expecting a return of 10%. Say for example, you generally expect a return of how much, sir? 10%. I said to you, I will give you 1 lakh, 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 1 lakh forever till you live. Till you live, I will give 1 lakh every year. You want that, or ask a bulk amount today itself. Ask a bulk amount today itself. Okay, ask bulk amount today itself. So how much will you ask? I said. You said, first I asked you, which one will you choose? 1 lakh till you live or a bulk amount today itself? Now you made a thinking and you said, till when I will live, I don't know, that itself is probable. Therefore, I will do one thing, I will ask a bulk amount today itself. 1 lakh, 1 lakh, 1 lakh, 1 lakh forever, ask some amount today itself, I said. You said, I want some 50 lakh. You said that I want some 50 lakh. I said, I will not give you more than 10 lakhs bulk today. Either take 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh forever. If not, take a bulk amount of 10 lakhs today itself. Sir, I will live at least for another 50 years, na, sir. 50 years la 1 lakh means it will come from 50 lakhs, na, sir. Why you are just 10 lakh means it is atrocious, sir. what is going on, enna pakshapatam. Everyone will have their own logic. But in reality, if you observe the case, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh forever till perpetuity is having a present value of 10 lakhs only, because 1 lakh divided by 10% will give you 10 lakhs only. Sir, that much meager amount. Sir, common sense you have to understand. 1 lakh next year, 1 lakh after 2 years will have a same value or lesser value. 2 years will have a lesser value in the present value. 50 years after you are going to receive a 1 lakh, today that value will be somewhere around 2 rupees or 6 rupees. Like that if you do, it will come to 10 lakhs only. So sir, how can we prove this? I will give another way of interpretation for the same. How much bulk you are taking? 10 lakh. You said, sir, I will take 10 lakh bulk, sir. I will take 10 lakh bulk. What you will do with the 10 lakh bulk? Sir, I will deposit this 10 lakh bulk in a bank account at 10%. At 10%. Then I will have 10 lakhs and I will also have that 1 lakh with me. No. 10 lakhs when you give to the bank, your 10 lakhs has already been blocked. Okay. What is there? If you give to the bank or any other fixed interest security which is giving 10%, it will give 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh every year for the 10 lakh blocked amount. Once you withdraw the 10 lakh, now 1 lakh will stop. Means how can you interpret this? This 10 lakhs is equal to 1 lakh every year till perpetuity. So this formula is having their empirical proofs. Just like that, they don't write the formula. I repeat, I will give you 1 lakh forever till perpetuity. You die na, your parents, sorry, your children, or whatever the case may be, sir, whoever will live, to them we will give. Like that I said one statement. Ask some amount today itself. I gave two options. Either to you or to your ancestors or to your next lineage, etc. I will pay you. Ask a present value today itself if you want a bulk. Either choose 1 lakh every year or choose a bulk today. A person said, "Are future night is unpredictable. I will take bulk today." If you take bulk today, I will not give more than 10 lakh. Are saying that ancestors, everyone you will continue na. You pay 10 lakhs, at least pay 50 lakhs or 60 lakhs. I will not pay. Why? Your expected return is 10. 1 lakh per annum at expected return of 10% will have a present value of 10 lakhs only. How we can prove? Listen, I repeat. Go to a bank. Go to a bank. Deposit this 10 lakh. Your 10 lakh is locked now. 10%. Every year, how much bank will give? 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, it will pay. Who will pay? Bank will pay that 10 lakh rupees. Every year it will pay. Oh, sir, 1 lakh rupee. You may ask, sir, I have the 10 lakh, I also have that 1 lakh with me. You don't have 10 lakhs in your hand, you can't use the 10 lakh. The moment you withdraw the 10 lakhs to use, 1 lakh will stop coming. That means how to interpret this? This 10 lakhs is equal to 1 lakh every year till perpetuity. Therefore, it is empirically proved that cash flow per annum divided by RR will give the perpetual value, present values. Okay. Perpetual dividends, so 2 rupee, 2 rupee, 2 rupee, 2 rupee, like that it is going on coming. 10% is your expected return. 2 divided by 10% will give you the present value of the particular asset or a share, whatever you call. Clear? This is without a growth. This is what's a without a growth. Now let us take the same thing with the growth, how it will look like. Hope everyone understood the concept up to here clearly. Right? So first write down the notes up to here. We will continue. Write down, sir. Write down the notes. Okay, so hope everyone completed writing this. Next one. So now we are going to analyze not just the present value of perpetual cash flows, how the share price will get impacted with the growth. Let us try to understand how the growth is going to impact the share prices. That model we popularly call it as garden model. Which model, sir? Garden model. So now we understood that dividend is in the numerator. Dividend by KE will only give the price of a share, na? That means it is very clear that dividend is there in the formula, na? Therefore dividend impact the share price. So next one, dividend growth model as per garden. Dividend growth model as per garden. You have seen in the institute study material, na? First 3 pages lane garden model, their formula derivation also given. That means institute is expecting the student to have the knowledge of the derivation. Okay, so no Vijnana Pradarsana here. We have to understand the concept because it is there in the study material. So empirically I am also proving that it is there in your study mat. Okay, see here. If you observe the institute study material, they have given derivation, how it came. So clearly he said that perpetual geometric series, also called as a geometric progression, perpetual. Okay, so d1 by k minus e, how the formula derived. Dividend growth model, this is also called as a garden's dividend model. Okay, but there is a growth here, dividend growth model. Dividend growth model and PE multiple, all these things we are going to learn now. Okay, so let us try to understand the model and its analysis. Okay, let us start. See here, two completed, number 3. Gordon's model they will call. What model, sir? Gordon's model they will call it. Okay, let us understand what this model all about. See here, Gordon has formulated that is influenced by, is a influenced by 3 factors. The 3 factors which influences the stock prices are: number 1, first one is the dividend. Second one is the expected return. Third one will be growth rate. Third one will be the growth rate. Dividend means dividend expected. Dividend expected. Expected dividend, we call it as a D1. Okay, we call it as D1 to D infinity. KE. Growth rate we notate with G. G is already having another analysis. G will be equal to B into R. Meanings I will tell you later. Okay, meanings we will discuss much later. So what Gordon model said is, as per dividend growth model, Okay, very important formula. P naught equal to d1 by ke minus g. P naught equal to d1 by ke minus g. Okay. P naught equal to d1 by ke minus g. D by ke is next changed to d1 by ke minus g. Change it to d1 by ke minus g. Now let us understand the modus operandi of this model, how they actually operate. Here the notation P naught equal to current value of the share. When I call value, fair value. Market already available. Okay. So first one, P naught equal to current value of the share, also called as a fair value. D1 equal to expected dividend for the next year. KE equal to cost of equity. G equal to sustainable growth rate. P naught equal to D1 by KE minus G. This is a formula given. Now if you interpret this particular formula, if you observe clearly, when calculating the value of the share today, we are considering infinite dividends. We are considering next year dividend. We are considering infinite dividends. P naught equal to infinite dividends, numerator, or next year dividend. That means we are considering the very next year dividend, or we are considering the infinite dividends. We are considering the next year dividend, because D1 means the dividend of the next year. It's not infinite dividend. Okay, therefore our price is dependent on the very next year dividend, but not on infinite dividends. Like this, you should not think formula has infinite dividends inside it. Where, sir, only D1 is taken? I will explain. This requires a lot of analysis. Please, everyone, listen carefully to the logic. So what Gordon tries to explain is, I am now trying to derive the formula. Okay, let's see. What is the value of an asset? Present value of future cash flows. See here, sir, everyone participate, listen carefully. Okay, year, cash flow, PV at the rate of KE, PVCF. Year 1, year 2, year 3, so on till year n. Cash flow I get on the share for the first year, I will call it as D1. I will call it as D2. Call it as D3. I will call it as Dn. PV at the rate of KE. Whenever we have to calculate, what we will do on the calculator, sir? 10% rate if you have to do, what we will do? 1 divided by 1.10. Okay, may not be visible, but what we will do is 1 divided by 1.10. 1 divided by 1.10 means what we are doing? 1 divided by 1 plus 0.10. 0.10 is the required rate. Therefore 1 divided by 1 plus KE, I can write like that or not. 2 years if you want to do, you will square this. Means I have to square this. Okay. Okay. One divided by 1 plus KE power 1. whole square. Whole cube. Whole power n. Let's multiply both of them. d1 by 1 plus ke, d2 by 1 plus ke whole square, d3 by 1 plus ke whole cube, dn by 1 plus ke whole power n. Total. Observation required. In the capital budgeting mini problem what we have taken at the beginning, cash flows, PV factor, everything calculated, we call the summation as fair value of the asset. Here we call it as fair value of a share, also called as a P naught. P naught will be the summation of year 1 PVCF, year 2 PVCF, year 3 PVCF. Okay, till year n. So I will be calculated as a continuing document. See here, place is not enough for me, therefore I will calculate separately. So if you ask me P naught, what I will tell now? Sigma d1 by 1 plus ke, d2 by 1 plus ke whole square plus d3 by 1 plus ke whole cube plus so on plus dn by 1 plus ke whole power n. This will be the price of this particular share. Okay. So d1, d2, d3 like that, till when I will pay? Till perpetuity you will pay. What is perpetuity? I really don't know. Therefore, a progression is going on like this. If you observe clearly, let us say for example, in the place of ke in the denominator, let us put 1. 1 plus 1, 2. 1 plus 1 whole square means 2 square. 1 plus 1 whole cube means 2 cube. Like this it will go on till 2 power n. 2 power 1, 2 square, 2 cube. Okay, 2 power n. This is called as a geometric progression. This is called as what progression, sir? Geometric progression. Till when it continue? We don't know till when it continue. Therefore, we need to put some limiting amount for this. Like this, how many years you will take? Go on taking me, there is no limit for that. Therefore, there is a limitation concept of geometric progression which we have learned in CPT mathematics. Na? The value is y equal to a by 1 minus r. Okay. A equal to first term, also called as a predecessor term. Okay. R means second term by first term, also called as predecessor term, successor term by predecessor term. Here y in our example is the P naught. We want one limiting amount for that particular share. A equal to first term, R equal to successor term by predecessor term. This will be successor, this is predecessor, this is successor, this is predecessor. When you take first two, D2 and D1, if you take, let us take this is 1, this is 2, this is 3. A by 1 minus R la, A here represents D1 by 1 plus KE. If you compare 1 and 2, if you compare 2 and 3, A becomes D2 by 1 plus KE whole square. It depends on what is the series you are going to take. So in a series of geometric progression, any two things if you take, second term by first term, third term by second term, 100th term by 99th term, like that it will be nth term by n minus 1th term. Like that they will continue. Successor term by a predecessor term. Okay, now listen carefully. Now we need to derive this. Here for our example, A equal to first term d1 by 1 plus ke. d1 by 1 plus ke. Okay. So let us put it in a box. Next. This is number 1. Next one. R equal to second term by first term or third term by second term. I will take second by first. Easy for understanding. d2 by 1 plus ke whole square divided by d1 by 1 plus ke whole power 1. We can take to the numerator and we can multiply na. It will look like this. d2 by 1 plus ke whole square into, okay, 1 plus ke by d1. I can reformulate it d2 as d1 into 1 plus j divided by 1 plus ke into 1 plus ke into 1 plus ke divided by d1. d1 cancel, 1 plus ke cancel. So finally R equal to 1 plus g by 1 plus k. This is the second thing. We now got A, also we got R. We want A na R, A by 1 minus R, A by 1 minus R. So now our term is now to calculate 1 minus R, 1 minus R, 1 plus g by 1 plus ke. Okay, if you take numerator, 1 plus ke minus 1 minus g. Okay, so minus 1 plus 1 cancels each other. So simply the answer is 1 minus R equal to ke minus g by 1 plus ke. Done. Number 3. So we now obtained A, R, 1 minus R. We want A na 1 minus R, R 1 minus R, A by 1 minus R, A by 1 minus R. So P naught equal to A by 1 minus R. P naught equal to A d1 by 1 plus ke whole divided by 1 minus R, ke minus g divided by 1 plus ke. P naught equal to d1 by 1 plus ke into ke minus g by 1 plus sorry into 1 plus ke divided by ke minus g. 1 plus ke cancels each other. P naught equal to d1 by ke minus g. This is how the formula has been derived. So P naught equal to d1 by ke minus g has arrived using this derivation. This is what Institute has given. Institute didn't explain this much in clarity. They directly made the steps. I tried to make more mathematically illustrative possible. That's what I can do. So now listen carefully. From this, the moral of the story. If you observe this entire structuring of pricing, entire model whatever we have done, we considered D1, D2, D3 till infinity. Price also will include D1 by 1 plus KE, D2 by 1 plus K whole square till Dn. That means we are taking 1 year dividend, we are taking infinite dividends, but the formula what we use, D1 by KE minus G, suppresses all these facts. So listen, formula will always make the life simpler, no doubt, but it will, on the other hand, it will also damage the whole operational view of that particular model. Therefore, in the classes, we are not just concentrating on reading and understanding the formula, we will also concentrate on understanding the meanings, interpretations, and derivation. Every formula, I am not talking one, every formula. Portfolio 36 formula like this: background, analysis, interpretation, derivation. Once you understood 100 problems, 120 problems also you will do. Concept is the main source. So problem doing is only a means to understand. It is not the only way. It is one of the means to understand the model, but it is not the only way to understand. Background we need to understand very clearly. So hope everyone understood this particular concept. How do you feel about this? Please put a comments in the message. It gives a lot of encouragement for us. Okay. So this is all about understanding the dividends growth model. So growth will influence or not? Necessarily growth will influence. Okay. This will be the third part of our discussion in this chapter. Okay. Till now whatever we have made, no problem I have done till now. I didn't even put a pen on paper with a problem. This is all forming part of securities analysis chapter in our syllabus. To make it more interesting, I can take financial management, derivatives, futures, options, currency options, swaps, interest rate risk management. That also you can explain. But I want to show you the real intent of SFM. It is not just about doing the problems. It is about understanding the meanings of various things inside. It is about analyzing the securities. It is about analyzing the market rather than putting pen on the papers and doing the problems. Okay. So hope everyone understood the ideology behind the subject. This video will cut with this. Next lecture will be on understanding PE ratios, sustainable growth rate, fundamental analysis of stock, technical analysis of stocks we will discuss in the next lecture. Okay, so how you felt about the lecture? Please put a message as a comments in the YouTube lecture. Those who have already taken the crash batches, please put one message as an encouragement. How you felt? If you didn't understand, please tell that you didn't understand. If you felt that lecture is useless, you put that. At least we will get one chance to rectify things. Okay, so please. Thank you very much. We will again meet in the next lecture for sure. Thank you.